Most traders think that support and resistance is as simple as drawing a few lines on the chart. The problem is, most traders are drawing those lines incorrectly without realizing the significance of the indicator. They're either drawing too many levels, identifying wrong key areas, or completely misunderstanding how support and resistance actually works. In this video, I'm going to be breaking down the exact process I use to identify key levels so you can trade with more confidence and avoid some of the most common mistakes traders make. So let's get into it. Keep in mind that accurately identifying support and resistance levels are one of the most important skills a trader can have. So why are support and resistance such an important indicator? Because if you can accurately identify key support and resistance levels, you'll be able to make more informed trading decisions, improve your risk to reward setups, and eliminate unnecessary trades. Instead of chasing price action and reacting emotionally, you'll have predefined areas of where you're planning your entries and exits on every trade. Let's take a look at this example, where we can see multiple rejections which cause the price to reverse trading direction. Since the price is failing to go above or below this range, we can assume that selling pressure and buying pressure will continue if these areas are reached again. Therefore, it's best to set a buy order close to support and a sell order close to resistance. Disciplined traders who follow this process will often see greater returns since they are minimizing their downside risk and maximizing the yield from the trading zone. As opposed to the traders who make the mistake of drawing too many lines on their charts, their entries and exits become more confusing, which can result in greater losses. Keep in mind that the point of identifying these key levels is to reduce confusion and increase your confidence as a trader. Focus on trading the major rejection areas to help reduce noise and increase your risk to reward ratio. The traders that are struggling to find accurate key levels are likely not following the basic fundamentals of support and resistance. The first one was mentioned earlier, which is multiple rejections. Locating the areas where price is repeatedly rejected will give you a huge advantage when deciding your trading bias. Next is understanding that key levels act as both support and resistance. This means trading bias is determined based on the side price action is trading on. Here's an example of a bullish breakout where price breaks past resistance, pulls back to retest the key level, and holds at support before continuing to the up direction. The opposite is true for a bearish breakout. When price breaks below support, the key level is often retested as resistance before continuing to the downside. When a breakout occurs, it's important to confirm continuation or a trend reversal through a candlestick pattern. Although candlestick patterns aren't covered in depth in this video, it is worth mentioning. Trading within the current price range is the next fundamental to be considered. When marking up your key levels, it's best to stay within the current price action to set realistic price targets. In this example, we're set up for a short play. Therefore, we would enter our short position at resistance. Our take profit should then be the next major support level. Anything else is considered noise and should be avoided to reduce the chance of greed taking over the trade. The last fundamental to consider is trade confirmation. Successful traders will typically confirm a trend reversal from a break in structure. Chart patterns are an ideal resource to use for this type of confirmation. While I don't cover all of the chart patterns in this video, one that pairs well with support and resistance is the head and shoulders pattern. In this example, there are three areas of consolidation consisting of highs and lows, which form the left shoulder, the head, and the right shoulder. The head and shoulders pattern is used with a bearish thesis in mind. When the price breaks down into the right shoulder, traders use resistance as an area to short the price down to the next support level for their price target. To take this one step further, an inverse head and shoulders pattern is used for a bullish thesis, where a breakout into the right shoulder and a retest off support signals an entry with the price target at the next major resistance level. Now let's jump over to the chart so we can see real examples on how this strategy plays out. Taking a look at the 15-minute time frame on the spot, we can find both of the chart patterns I spoke about. The inverse head and shoulder is going to be in this section here. We're going to have the regular head and shoulder pattern in this section here. So let's identify the head and shoulder pattern real quick so we can clearly identify what's going on here. So if we move over, we have our left shoulder here, our head, and the right shoulder. Now, if we go back to our example that we spoke about, when we have an inverse head and shoulders pattern, we're looking for a bullish breakout. And you're actually seeing that happen once it breaks into the right shoulder here. We have that retest consolidation before it breaks out to a higher high. Now, if we look at the higher high level here, we have a smaller head and shoulders pattern forming. So we have a little bit of a consolidation here, the head forming here, and the right shoulder forming here before it breaks to the downside. So this would go back to the example that we talked about with a little bit of a consolidation in this right shoulder, break into the head, consolidation before it breaks back down into the right shoulder, consolidation, hits that resistance level, and then sells off. So if we were looking at this pattern, we would assume that this retest over on this area, on this day, on the 22nd of June, would be a sell-off day, right? So now we're going to clear this up, and we're going to draw some support and resistance levels to see exactly how that plays out. So marking up the chart with our support and resistance levels, we want to look for major key areas. If we look at this area here, we can see multiple rejections here, here, right? So we're going to mark this up just as a baseline, right? If we need to adjust, we will. But this is looking like a pretty solid area to use as a key level because we're seeing a bounce here, right? So we have a huge sell-off, some green candles forming, holding a little bit of consolidation before it breaks that level. It finds a new low, right? So we're looking at maybe around here, okay, for a level of support before it retests that area, consolidates back down, retests again before it really kind of flushes into that head section that we spoke about before, right? This is going to be the head of the inverse head and shoulders pattern, right? So we're not too concerned with this area just yet. This is just shown for more of the example side of it. But this is going to be our head, obviously, with the inverse candle or the inverse head and shoulders. So we're going to be breaking back above that. We're seeing once it does break back above that, we get that retest, right, on that support level, hits that resistance, rejects, comes back down, holds that level of support, retest before it breaks out. So I'm thinking that this area right here is going to be a pretty good area to keep on our charts for our major key levels. So moving further ahead, we're seeing that once this breaks above 749, we're getting a push up towards the 756 range. And we're not really too concerned with this because our current trading zone is that 749 range. So even though prices did reach that high, we want to remember to stay consistent with where we're trading at currently. So once that does break down towards that 749 range, we want to highlight that as a key level, right? So we're getting that bounce, we're getting a hammer candle, it looks like, a push up, a retest before it ultimately flushes through and finds support back at 742. So we're getting that consolidation forming again. We get a retest, hold at a key level at 742, and then a push back up towards 749. So going into this trading day on June 22, we want to assume that this is going to be a bearish outlook on this day. So assuming that this holds as a level of resistance, we want to take a short trade at this point and ride this down towards 742 for a take profit zone. So we're going to jump ahead a little bit to see exactly how that plays out. But this is really about highlighting our key levels and just holding to our trading plan. So even though there's going to be some FOMO to the upside, you want to remember that this is a key level of rejection. So it is the best to take a short trade here and ride that down to 742. So jumping ahead just 1 hour, we're seeing that rejection off that key level of 749. So already this trade is playing out fantastically. We're getting that rejection level off 749 here where we entered for a short position, and it is slowly starting to creep down towards that 742 take profit zone. So if we were to trade this, we would hit right on the mark of that key level, and we're just holding right now and just waiting to see if that continues to sell off down towards that 742 range. So again, I'm going to jump ahead further and see exactly how that plays out to see if we do hit our take profit zone or if it decides to catch some momentum here and push past that 749. So jumping ahead just 30 more minutes after the sell-off began, we can see that our price target hit, with demand entering the market close to the 742 range. So let's zoom in a little bit to see exactly what happened here. So taking a closer look here, we can see that consolidation began to form before the sell-off began. So if we were to identify the area of entry, we would say that the break back below the 749 resistance level is our perfect area to enter for a short position. And that's exactly what happened after this candle closed below the 749 range. The market started to sell off and continued all the way down to our next key level of 742. Now, this is not always a perfect science, and you have to work on being more accurate with picking your zones of take profit. However, this is a very great strategy to use to become successful in the market. Now, one thing I do want to mention in this example is a stop loss. Now, let's just say we did enter on this candle here. So this is going to be the area that we enter for a short position. Let's just say this did not go in our favor and it did decide to push back to higher highs. So if the market did decide to have a green candle, let's just say here, it broke back above and then it continued to the up direction. Well, we want to have our proper stop loss in play. So since we did get a break above this 749 key level, we are identifying a high of this consolidated period. So a great area for a stop loss would be the high of the day, which is 750.18. So if we were looking at this as a risk to reward ratio, you're looking at a very high risk to reward ratio because you have a stop loss zone here, and then you have a take profit zone all the way down from 749 to 742. So this trade turned out to be a fantastic risk to reward ratio. That's going to do it for this video. So if you found this helpful, make sure you smash that like button. If you want to take this strategy to the next level, hit that subscribe button and check out my other videos where I dive deeper into options trading. Until then, peace.